everyone. Welcome to the Crush the Premium show. What a week that was. We had volatility all over the place. Last Friday, we closed week with the VIX well into the 20s. And sure enough, we had a kind of a Black Monday follow through, which is often the way these things happen. Certainly not predicted, but certainly the way things happen oftentimes if you look back through some of the crashes in history. And sure enough, we came in Monday morning, Nasdaq's futures were down 6%, S&P down over 4%. So things got really, really ugly. And so let's talk about it a little bit, but also talk about some of the data and some other things that are on my mind. It was very interesting, but we should always sort of move back and look at it from 30,000 feet just in order to be able to kind of understand the structural issues, but as well as the overall picture, because the overall picture is what we're usually led by as investors, most certainly. As traders, not as much. We're looking a little bit more short term, but we want to have an idea of where things are going, broadly speaking. So today we're going to talk a little bit about the VIX and volatility. We'll talk about the transition mistake, right? This is a mistake I see people make all the time. And when I do a lot of coaching, I have a lot of students, and this is what I really try to drill into people. It's very, very hard to do, but it's something that we need to understand, especially when we're in the business of option selling. So what do we have? We had a massive VIX move this week, guys. It was insane. And I always love Douglas's tweets. He sort of compared it to a couple of the other big spikes that we've seen. We got to about 65 this week on the VIX. And back in the financial crisis, we are a little bit higher, probably closer to 80. But in 2020, we had almost roughly the same levels. We were pretty close. And so he's saying, let's look at the worst events of our lives. Financial crisis, where literally the structure of the backbone of finance is falling apart. So of course that made a little sense that we had a spike there. COVID, which was an existential threat to humanity, even though it was far, far overdone. As we saw in the end, but there was a real fear in the air, as we all recall. And then this week, Japan raises interest rates by 0.25 percentage point. Boom, same kinds of VIX levels. So kind of funny in a way that he puts that. Of course, it seemed very overdone given, and of course we did have that employment number on the Friday as well. So that started to get people nervous about the economy starting to soften. So for a long time, we've had this bad news is good news type of environment, because bad news means inflation can be coming down. And inflation has been enemy number one for a couple of years now. So we've all been kind of focused on getting inflation down, and then everything will kind of respond from there. Suddenly, as inflation has now started to kind of come down to those levels where the Fed is a little more comfortable and people can kind of accept to some extent, even though, prices are up a lot over the last 4 or 5 years, no question, but we can kind of accept sort of 2.5-3% inflation. But that means that we are now betting on the economy not having a hard landing. So this whole idea that if interest rates come down because inflation is now under control, but the economy is okay, in other words, rates are coming down because real rates are too high, meaning risk-free rates over inflation, right? If there's too much of a gap there, then you are unnecessarily restricting the economy, is basically the theory behind it. If rates are too high and inflation is nice and low, why are we keeping rates high from the Fed's perspective? So let's bring them down. But if rates come down, along with the economy softening severely, or us looking at a bad recession, then stock markets don't like that. So there's a lot kind of hinging on this idea of rates coming down, but things kind of staying okay out there, which will help things like small caps and stocks in general. But if we head into a situation where the Fed is maybe behind the curve, I don't think they are, but let's say they're behind the curve and they didn't act quickly enough, and the economy sort of goes into the garbage a little bit, then we've got a little bit of a problem on our hands in markets. So as a result, we had people worried about the economy on that Friday number, and then overnight all hell broke loose and the VIX basically decoupled from everything. So we can see here VIX performance versus SPX performance. So what this shows you, what has the VIX done versus the S&P 500 moving down. So if the VIX goes up, that's not abnormal when the S&P goes down. That's a normal thing. But when it goes up to this extent versus what we had, which was down kind of 4% on the S&P, which is nothing to sneeze at, but the VIX went to 65. And that is very, very panicky in the face of what wasn't, for example, a 10 or 20% drop in markets. This wasn't 1987. The last time we saw something like this was 2018. We called that event the Volmageddon. And so it was a similar decoupling of VIX and S&P performance, because the VIX is really tied to S&P volatility. It will deviate, of course, but it's kind of like, if you sell, it's basically the cost of insurance for the S&P 500. You can think of it as that. And so it should have some relation to the underlying risk of the S&P 500, right? Like think of it as, car insurance or house insurance, let's say. If the underlying risk to an insurance company of your house burning down is 1,000, then they're going to charge you 2,000 for it, and they make money. They reinvest it and they make money on that. If the underlying risk is 1,000 and they suddenly charge you 50,000, well, they're overpricing that. So the VIX overpriced, in a sense, what we were seeing versus historical moves that we've seen, right? So this kind of decoupling is usually a sign that something strange is going on out there, something strange. And of course, we began to talk about this yen carry trade that has been something that a few people have talked about, but has started to concern people. And we figured that sort of started to snap. So this idea of people borrowing at very, very, very low rates in Japan and using that to invest everywhere else in the world is called a carry trade, right? This is something that people have done for a very long time, but when they start to overdo it, it has this potential to snap back. And Japan raising rates, even though it's only a quarter point, starts to worry people. And sometimes markets just need things to change at the margin. The quarter point doesn't sound like very much, but the impact it has on a carry trade that could be worth $5 to $20 trillion, that has a ripple effect. And so people start to worry, well, is this the beginning of something very severe where we are starting to pull in the reins on leverage? And the market goes through cycles. Every time we have a crash, it's something related to leverage and over borrowing and things like that. So this is the same kind of stuff every time, just in a slightly different form. And so the carry trade represents this risk that, okay, is this a sign that things have gone too far, borrowing at this rate and pushing your money into the Mag 7, for example? Is that what happened? Is that what people have been doing? They've been borrowing cheap and pushing their money into this very low concentration that we've seen in markets, which is like 7 to 10 stocks basically doing most of the heavy lifting in markets. So has everybody been kind of squeezing into this one boat? And did we finally see that snap a bit as the boat capsized and caused a lot of panic? So that could be what happened. We don't know. There's also Iran, Israel. Is there something going on there? Of course, there's that ongoing risk of something escalating. And there's political issues. Suddenly Harris is caught up to Trump. So are we, is there some uncertainty creeping into markets as to the election result, which is a little bit overblown. Everybody thinks Trump is better for markets, but history has shown that Democrats have basically done well for the stock market over time, right? So I don't know if there's a lot to that fear, but hey, this is how narratives work. People grab hold of one and they run with it. Volmageddon was mostly these products that everyone pushed into these short volatility products back into 2018. And that market was gigantic. If you look here, there was a lot of AUM that really pushed things around. So this had nothing to do with those kinds of products. They've never really recovered since those days. They're nowhere near what they were at that point. So it didn't really have to do with that kind of short volatility trade, but it might have had to do with other kinds of short volatility trades. And you can think of long stocks as short volatility. You can think of many trades as short volatility, inherently short volatility, because when things go wrong, volatility explodes. So a lot of things are short volatility, and we saw short vol trades explode all over the place. I believe we're going to start hearing about more desks that got hurt, maybe some funds that are closing as a result of what happened. And that's just kind of par for the course. It happens every 5-8 years. Everybody kind of does one thing and it blows up, and they close up shop and they open up another one, and round and round we go. But what happened this week? Tuesday, the Bank of Japan came out, Uchida came out and said, hold on a sec. Look at the last line here. Therefore, the bank will not raise its policy interest rate when financial and capital markets are unstable. So they noticed what happened. They noticed the 10 or 12% drop in the Nikkei. And they said, okay, hold on a sec. So they are central banks. This is not your father's central bank era where they let things kind of figure themselves out. They let price discovery work its way through the system. No. Central banks are now very aware of the wealth effect from markets, from asset appreciation, and they do not want, first of all, they don't want the plumbing of the financial system threatened, which makes sense, but they also don't want assets to go down. Let's face it. So they are going to get in the way, and again, markets have proven that they can bully central banks, because right here, Uchida comes out and says, okay, hold on a sec. If you're going to do that, then we are going to be a little bit more measured in our rate hikes. We're going to be a little bit more careful here. Let's not get too crazy here, Uchida's saying. Okay? Don't take us too seriously. We're going to raise rates, but if you don't like it, then maybe we'll reconsider, right? So that's kind of what he's saying. So Tuesday we had that. Soothed markets quite a bit. And then Thursday we had some employment data that came out that was very positive. And this was the second piece of the puzzle. The first piece was the carry trade. We checked box number 1 a little bit on the Tuesday because the BOJ said, okay, hold on. We're going to take our time, or we're going to wait and see. Thursday, we checked the second box is the economy heading towards a hard landing? We had a good number. And this hard landing stuff is complete BS in my opinion. We're going to talk about some data in a moment. But as a result, we saw the VIX. Basically, we hit 65 and we came all the way down. Friday, we got crushed all the way down to 20, which is an interesting level. Usually when you have this kind of panic, you have a bit more of a volatility echo. I would have expected maybe a little bit of a retest of maybe, high 30s, 40-ish kind of range. But we filled right in. Those two events, Tuesday and Thursday, really, really soothed the concern in markets. And we had volatility fear gauges collapse, right, like this. And there's one called the VVIX, which is volatility of volatility, which also really got crushed from around 180 down to around 120. So the measures of fear definitely came in. VIX futures still not out of the woods, right? We see that front future a little bit higher than the second future. That's a sign that there is still some durable fear out there. Now we see October higher. That has come right back up again as Harris, Trump are neck and neck. So there's uncertainty surrounding the election, and that's normal in this curve here. I wouldn't read too much into that, except that they're worried about the election. So VIX futures curves are kind of anticipating the volatility down the road, and they're anticipating some worry surrounding the election. But the part that you have to look at is, number one, VIX cash is above the futures, so a sign of stress, and the front future is above the second month future, a sign of stress as well, and the front future is still above the fourth and fifth futures. So this is still not a sign of calm by any measure. Is it normal after the kind of dislocation that we saw? Maybe. This doesn't necessarily mean things are going to get ugly again. It just means that it takes time for volatility to adjust, right? When a hurricane just happens, what do people do? They rush out. Even though the hurricane's done, everyone's rushing out to hardware stores and getting ready for the next one. Is it reasonable? No, it might not come for years. But there's this volatility, the echo that kind of remains as people have this recency bias. They remember what just happened and it was painful and it was worrisome. And so it takes some time for these things to unfold, which is, I have to say, I'm surprised VIX has come down to 20. That's implying maybe a 1.25% move per day. That's not much. We've had some big moves lately. So the VIX, I would argue the VIX is maybe a little bit on the cheap side. And the futures are kind of saying, yeah, we're still a little bit worried. But what about data? Are we really worried about something? Now, I hosted the Leduc trading room all week. And right on Monday, I said, listen, as traders, we are looking at things differently from things as investors. So as traders, we were worried. We were wondering about CTA buying, this sort of all these futures, all these volatility targeting funds, for example, right? These are funds that allocate to stocks when volatility is low, but when it breaks and it goes up, they have to start selling stocks, and that can kind of cascade, causes a waterfall of selling. And because of these kinds of strategies, we're really more, volatility is more clustered than ever. It can stay low for a very long time because all things are kind of pushing it lower. Many things keep pushing it lower. Stocks are going up, so they buy more stocks, which leads to lower vol, which means buy more stocks, and it makes stocks go up more. So it's a sort of circular positive feedback loop. But the opposite can happen. When things break and go the other way, stocks are going down, volatility is rising, we got to sell stocks, which makes stocks go down, which makes volatility rise. It means we got to sell more stocks. So remember, there's these sort of this kind of push and pull. Oftentimes there's a clamp, nothing's going on. We can talk about dealer gamma another time. Dealer gamma is very short down around 5,100, 5,200. That exacerbates things as well. When dealers are on the wrong side of volatility, they panic, and that pushes things around, exacerbates moves. So I just talked about it, but in a nutshell, that's kind of what it means. Above 5,300, we get positive gamma, so that's a good thing. If we can get the market up to 53, 54, 5,500, we could see a lot of calm come back into markets. And this will have all been a bit of a flash crash mistake that happens every now and then. But let's look at the economy. As I was hosting this room, I said, listen, as traders, we are worried and we are watching, and we are definitely not going to be complacent. And I suggested buying some protection and some insurance. But I said, listen, this talk of the economy falling off a cliff is utter nonsense. I said, I'm adding to kids' accounts. I'm adding to long-term accounts. This is an opportunity that I like here, that I feel is compelling. And we look at data. Here's some new data out today. We've got restaurant bookings, very solid. We've got U.S. air travel data, no problem, very solid. We've got, here's some retail sales, great, looking good. Restaurant bookings we've already seen. Weekly jobless claims, nothing going on, nothing to see here. Jobless claims are down. In fact, there's a good argument that this whole unemployment rate going from 4.1 to 4.3 is really a little bit of smoke and mirrors. And Torsten Slot made this argument. A couple people came out this week and echoed that. There's not a lot of compelling evidence that employment is under any sort of stress. Look at this, very low level of job cuts. So remember, unemployment can go up if supply expands. How does supply expand? Like this. Immigration. So we have a lot of immigration. Immigration is soaring, so more people are available. And so it's not so much that companies are firing. Of course, we see it in the headlines. We are concerned, and that's what sticks in your mind. This tech company fired people. That company fired people. But overall, there's really not a ton of firing going on. If anything, companies are struggling to keep people. Which has been happening for a few years now. So look, job cuts are very low. What we have is increasing immigration. So this 4.3 number, I don't think there's a lot to hang your hat on there as a bull. I really don't. So in the end, data's pretty good. Now I will say, I wanted to mention one thing. Remember, data and reality doesn't always equal stock market reality. Right? There's still something called margin compression. There's multiple compression. Apple hasn't done very well in the last, as a company, hasn't done very well over the last few years. It just hasn't really moved the needle. What has it done? It's bought back a lot of stock. Tim Cook's very good at buying back stock. He's a genius when it comes back to doing that. And that's good for investors. I'm not saying it isn't. I love that as an investor too. I prefer to see some innovation and things that can kind of point to long-term sustainability of innovation and progress. You can't just buy back stock all the time and never improve. Now maybe Apple can, because it just has such a loyal following and good service side of the business. But Apple's gone up $100 anyway. So this is multiple expansion. This is markets going, okay, we'll pay more for stocks just because there's money around, because of that kind of thing. So we need to understand that markets will do what markets do. It doesn't always relate 100% to reality. And so when I look at travel data, fantastic. Travel data is very healthy. Restaurant data is very healthy. Hotel bookings, very, very healthy. But what happened to Airbnb this week? Got crushed. Here's Airbnb, boom, boom, boom. And I was surprised. Everything was pointing to things being good. Now, I was worried earlier in the year. I thought, the prices people are charging for these Airbnbs are outrageous. These have to come down. I think that's what's happening. They're saying there is margin compression from investments, but I think there's margin compression going on out there in general. So what happened in COVID is travel, just post-COVID, everyone was YOLOing. You only live once. We got to make up for lost time. We all almost died horribly, right? And not to make light of that, but definitely overblown. But hey, everybody, we get this feeling every now and then. It happened after 9/11. It happened after the financial crisis. Everybody goes, oh, I got to live again, because life isn't all about money. So let's go spend a bunch of our money, even if we don't have it, even if we're going to run up credit card debt and we're gonna regret it later. Let's live for today. Carpe diem. And so, that pushed, and airlines needed to make up for 2020, and hotels, and they took advantage. They jacked up rates like we haven't seen in a very long time. And they said, we've got to make up for some issues that we've had over a few years. That we're going to charge you up the wazoo to travel. And so all these wonderful margins expanded, and that coincided with everyone going, hey, I don't care, we'll pay anything for an Airbnb, we'll pay anything for a resort and a hotel. We need to live and enjoy life. So it pushed up. Now I think that's a little bit under threat, right? As we see inflation come down, we've come from this period where companies had license to raise prices. Very big difference, right? The last decade was the decade of deflation, of disinflation, deflation, whatever you want to call it. Nobody had any pricing power. It was just a race to zero on margins. It was a race to zero on prices. Everyone competing, cheap labor coming from around the world, etc. This is unraveling, right? Cheap labor from China, not so much the reality anymore, for example. So putting pressure on prices. COVID came, put pressure on prices. Now we've had this sort of peak in prices, certainly in the travel area, and they were some of the first companies to raise rates, hotels, etc. Those are coming down. So remember, even though travel data is very, very solid, that doesn't necessarily translate into a positive stock price. So don't forget that the market does not equal the economy all the time. So we have to be even better at this, and frankly, even a little bit lucky sometimes. And if you're in Airbnb, you got a little unlucky, because the data's pretty good, but I think margins are coming down, and I think people are starting to go, whoa, I cannot pay $20,000 a week for a house in San Diego or wherever you want to vacation. So we saw the travel and leisure ETF under pressure. Of course, everything was on Monday, but it's sitting below this support here. Definitely not looking great. So definitely things to keep in mind. Okay, the last thing I wanted to touch upon today is just a little educational segment that I try to go over with a lot of my students, because when you're selling options, you really have to understand that it's as much about staying away from bad and worsening trades as it is about finding good trades, right? So to give you an example here, here's your SMH, your semiconductors. You got some very, very nice uptrends throughout the past year or so. Here's a very nice uptrend. I certainly like how we kind of follow that 9 EMA. Sometimes we break through a little bit, but we do a lot of 9 EMA touches, really good. Little breakthroughs where you're definitely going to hold off doing any more put selling until the trend is reestablished, which it keeps doing here. Here we start to get definitely a bit worried. I'd be getting out of positions in here and probably covering some of those. If you've had a few good trades in a row, you might have to take a little loss on one of those. Then we get back into this trade here. Let's see, I can actually put in a nice trend line. Here we go across here. So once we break through here again and get above that 50-day moving average with the 20-day crossing the 50-day, you see this cross here? The 20-day crosses the 50-day. We're back above this trend line. You just cannot deny that this is starting to look good again. So don't fight it. Get back on board. We collect a little bit more premium. And here we start to get a little bit worried. Double top. We might be making new highs, but we struggle and we break down horribly. We break down through this very solid trend line. And this becomes a very different picture. So the difference between this A situation here and this B situation is what I call the transition. And this is often where traders get things wrong. They have this recency bias, which is, boy, I've had a lot of really good trades in a row, which might be some covered calls that worked out, maybe some short put sales, high conviction, right? I'd be looking at high conviction into this kind of thing, which we're going to cover in another video. We keep going and we've had a lot of wins. And I'm going to say this right now, and I need people to understand this. The last trade in a good campaign is often a loss. And what that means is you've had a bunch of wins in a row, and the last one where the picture changes might be a loss. So at this point here, your 9 EMA becomes resistance. And that's where I'd be looking for rallies back to cover any positions that I'm stuck on. And you can get harsh as well. If that's not your part of your repertoire, then just use this to stay away from getting long here. This is telling you that the picture has changed. And I saw so many people recently get killed in this trade. I mean, absolutely annihilated, trading triple levered semiconductor products and losing half their money. I mean, this is not necessary. What we have to do is get better at recognizing the transition. This is a transition from here to here. It doesn't mean we know exactly what's going to happen. Maybe we rally right back up into here, but this is a new picture and we've got to recognize that. And so we also can get confirmation from, for example, here's your semiconductor versus the SPY. You can see that semiconductors are outperforming the broader index. That's what this SMH versus SPY is telling you. Semiconductors outperforming, semiconductors underperforming, semiconductors outperforming, underperforming, right? So we know that the tide has turned versus the broader market. We know that some technical damage is being done, and we need to understand where that transition happens. So I hope that helps you guys, because really this is what it's all about. Because what we're doing when we're selling options is it's our best effort to capture what's called the volatility risk premium. That is the option pricing in excess of underlying actual risk. And the way that we calculate that is implied volatility versus realized, and it's a little bit of a deeper conversation. But basically, it's how much more are people paying for insurance than the insurance is technically worth, right? Than fair value, let's call it. Right? So how much is Warren Buffett with his insurance company selling house insurance for over what his actual risk is? And if it's higher than his risk, then he's making money over time. And it's easy to say that we're doing that with options. The problem is we have path dependence. We have strikes to deal with. We have these kinds of situations to deal with. We can't just willy-nilly sell options all the time and hope that it's going to work out in the long run, because we're always going to get difficult periods. And when we sell something for $1 and we have to buy it back at $20, we're doing unwinding a lot of good work, right? So on that last trade in the transition where you lose money, you have to make sure you're losing as small as possible, because you don't need that trade to turn into a minus 20, because it's going to outdo all of the good work you've done before, and sometimes even more. And that's what we've seen lately in these markets, is people are just getting their heads handed to them. I'm telling you, the body bags are everywhere. It's unbelievable. There's no sense in fighting this. Why are you fighting this downtrend here? Look at the MACD, pointing straight down, very weak. And that's one of the nice things about using a MACD. It gives you patience. It gives you this ability to go, you know what? I'm not going to catch this falling knife here. Why should I? Why should I try to catch that falling knife when everything is giving me an indication that things are heading down? The only thing that is that I have in my mind at this point is that, well, they've loved semiconductors for a year or a year and a half. That's what's stuck in my mind. You've got to be able to get past that, getting stuck with a narrative. You've got to be able to get past that. Let things unwind. Look, at this is starting to curl back up. This trade is going to look interesting again at some point. But I would rather get in once things actually stabilize, once they consolidate, once I have some indication that things are getting better. That's a big, big difference, right? Do you know why people keep trying to pick the bottom? Because they want to be the person who literally grabs that bottom. They can talk about it at the next water cooler visit or cocktail party or whatever. I picked the bottom on this stock. The problem with picking bottoms is you pick the bottom 7, 8 times. You pick the bottom here and here and here and here. Maybe you're right here. Maybe it keeps going. This still is unresolved. The problem with picking bottoms is you pick them again and again and again. I'd rather buy this up here when things start to look good again. I'm not going to feel bad about missing the bottom because I'm buying something that's actually starting to act well again. And the last 2 weeks have been a fantastic example of do not pick bottoms. If you're trading Dell and you've sold the 150 puts, Dell's now trading at $90. If you didn't do something about your last bad trade, you're now having to climb out of a massive hole. A massive, massive hole. And worse, if you kept trying to pick a bottom all the way down at 130, 140, 120, 110, 100, look, it might work out. Maybe Dell goes back to 180, but you are now stuck. And what we don't want is to be stuck when we're trading, especially when we're trading to try to generate income. Now we can try to wheel it and this and that, but make no mistake, you are now pushing a massive boulder up a hill. And it's not a good place to be in psychologically and certainly not financially. Your P&L is not going to be in great shape here. So the transition is very, very important. You can try to capture that volatility risk premium all you want, but if you don't respect path dependence of stocks, the path dependent nature of stocks, you're really not going to succeed in the long run. I'll tell you right now, just stop. Just stop trying to do it. It's going to be very, very, very difficult. So that's it for this week, guys. I hope you've enjoyed it. I hope you've learned a thing or two. I want to talk a little bit about my 4-day options challenge that's coming. We're going to be launching this week. This is going to be a free 4-day options course. And I'm telling you, I've packed a lot of value into this 4-day course. So try to sign up if you can. There's no obligation. Go to this URL right here, crushthepremium.com, 4-day challenge. Sign up for it. I can't guarantee you that you're going to get it tomorrow or the next day, but we're going to start sending this out to people very, very soon. And it's going to be really something cool. It's going to open your eyes to some interesting things that you can apply to your trading right away every day. Crushthepremium.com. We're not quite there yet on this course. It's done, but we're ready to launch that very, very soon. It's going to be fantastic. This is my coaching site. If you want to get in there, I'm getting a lot of responses lately because people are not happy with their results and they need some guidelines. And so getting some people reaching out saying, I need to be able to figure this out. Cashflow Insiders is my flagship program. 5 weeks of me live mentoring every week, full video course, one-on-one time with me, membership in my Discord, just amazing package. You get a full ecosystem that can surround you and support you in your quest to trade options well and to crush premium and to generate that options cash flow. A whole ecosystem really designed to help you succeed. Also implementing some terrific, we've got the MTI indicator, which I'm going to teach you in there, going to keep you out of things. People who listen to my MTI indicator are not getting in trouble the last couple of weeks. I'll tell you that right now. If you listen to that indicator, you are not getting in trouble. And I'm stepping it up over the next couple of weeks, putting in even more hedging ideas and even more indicators that are going to tell you when to get out and when to get in, when to stay away, when to get back in. So really some amazing things in the works. So check it out. And thanks for watching, and we'll talk to you soon.